companies will be struggling because they don't have adequate capital. So when we have that private capital injected in the firm so that it is back on its feet, that is what we refer to as private equity. Another thing that you need to note is that this equity or capital is not freely tradable in capital market. Think of it this way. A company A is struggling because it cannot raise capital even from the banks, for instance, because of very high cost of capital. It's what we covered in the capital structure lecture. So for that reason, this capital that is injected in the firm is not freely tradable in the stock market because it has not been raised through what we call the IPO. And why would you be interested in injecting private equity or private capital in a firm? You do this, you assess that company, you realize that the only reason why this company is not doing well is because of lack of capital. So it has the market scope, the products can sell, and therefore you do this with the hope that the value of the company will go up and you realize higher returns. Now let's see the organizational structure. The organizational structure. We'll be talking of the general partner. General partner in the private equity firm. This one is responsible for the management of the private equity firm. And I'll demonstrate shortly in the next slide how this happens. It becomes very clear to you. And normally, that person entitled in managing this money will get a management fee and will also get performance fee. What we also call the interest carried. Now, in most cases, it differs from one private equity firm to another, but it is normally 1 to 2% management fee. You might think this is a very small money, but when you'll be looking at the world's largest private equity firm, you'll be shocked at how much money is this management fee. What about the performance? Performance, there will normally be a hurdle rate. A hurdle rate implies that if it is in the records of the private equity firm that you must make 8 to 10% return for the institutional or high net worth individuals who have invested their money in this firm, if you reach that point, anything above, you get 20%. You get 20%. That is the general partner. Who else is involved? The limited partner. And who is the limited partner? It is you if you qualify to be called high net worth individual. You know who are high net worth individuals in this country? People with unbelievable money. You know them. And then the institutional investors. So you have that kind of partnership between the general partner and the limited partner. The general partner is the one managing your money. The limited partner is you who is bringing or injecting money into the company. Who is injecting money into the private equity firm. And the institutional investors, it could be pension funds. And you know them in this country. Pension funds. A good example is NSSF. But of course, there are other private pension funds. We call them provident funds. Provident fund. For instance, the university has one. So every end of the month, I'm deducted money that goes to my private pension. Every end of the month. But then I'm also deducted. Previously, NSSF used to be 200. But then that money, the rate has went up. I'm sure you are aware, the rate went up. So that I'm contributing much more than previous. So this money, if I'm NSSF, and I know you will get your money when you reach 55 years and above, I can invest this money in a private equity firm where I'll be getting some good returns. There is also what we call endowment fund. Let me give an example of an endowment fund. In your village, say in your constituency, your MP decides that the money that is normally given to the brilliant class 8 students when they are going to Form 1 from CDF of say 3,000, 5,000, it cannot really educate this child in high school. So he decides to do a harambe in the constituency to raise money to be educating the needy and brilliant kids. And say he manages to raise say 50 million. That 50 million, there is a committee, he comes up with a committee to manage that money. That money is what we call an endowment fund. Some NGOs also run endowment funds. And what you do with this money, you calculate the number of students who are going to Form 1 and how much they need. Say they need 4 million out of the 50. You remain with 46. Put that money in private equity investment, the 46 million. The returns, if it is 10% of that money, will be able to pay for the following year. So that every year, you just use the returns. And the initial money remains. That's how the endowment fund is operated. So, this is the structure now. You can see the general partner here is a private equity fund. It has a manager. It has a manager. Then you also look at the limited partners. You will find institutional investors. But you also find high net worth individuals. Insurance company, pension fund, large corporate, all those ones are what we are calling institutional investors. And I had also said high net worth individuals. People who don't actually care to check their bank balances. You know, I know you are constantly checking how your help, how your higher education loan money, how it is going down. I know you constantly check. But there are people who don't, and they run several accounts. You know, and they have hired a team that deals with the bank statements on withdrawals and expenditures. You know, people who can afford to move around with helicopters. Those are high net worth individuals. They also can invest their money in the private equity fund. Now the private equity fund here gets the money, invests in those portfolios you are seeing. Portfolio A, portfolio B, portfolio C. All those are different portfolios. Remember, in your CFI 1, where you dealt with the different types of risks in the topic of risk and return. Idiosyncratic risk, which is diversifiable, and the systemic risk. And when we talk of the idiosyncratic risk, which is firm-specific, you said that you diversified by investing in different portfolios whose returns are negatively correlated. Remember the Harlow-Markowitz theory. Don't put all your eggs in one basket. The strategic investment decisions. That is what the private equity firm does. And when we'll be looking at the different private equity firms, you'll see that quite a number of them, they invest in different sectors. That's what you're saying, portfolios A all the way to D. It can be more than D. I had discussed this. I had discussed what the general partner does and gets management fee, the performance fee, which is normally 20% beyond the hurdle that has been set. That is, I had already discussed that. The reason why not much is known about private equity is because we don't have much private equity in Africa, but it is really gaining traction. It is really gaining traction. 2/3 of all private equity firms are located in US. You have a quarter that is in Europe. Not much is left for the rest of the world. You know, some of you after graduating, you might end up working in these private equity firms. There are many private equity firms devoted to Africa only, but they're not operated from Africa. Yeah, you'll see. All the activities are devoted in sub-Saharan Africa, but they don't operate from Africa. 2/3 of the equity raise is devoted for leveraged buyouts. You find a struggling company, you inject money, it becomes yours. Yeah? That's why we started with financial distress. And then we moved on to mergers and acquisitions. And we looked at the different ways in which mergers and acquisitions happen, and we were left with the leverage buyout. Different types of private equity firms, mega funds. Mega funds is where you find investment in billions, and that's where you find the world's largest private equity firms. And they invest across all industries, and they do not invest in companies that are not mature, and those companies must have strong cash flows. The reason why IFC invested money in Safaricom Ethiopia is because, one, Safaricom is a mature company. Two, it has strong cash flows. World Bank have different arms. You know, there is even IDA, the IDA arm of World Bank, which President Museveni was complaining about the other day when he was in Nairobi. And there is the IFC, International Finance Corporation. It has injected private equity even in KCB, you'll see. Then you have the middle market. The middle market is defined because of the kind of money that they are spending, 500 million to 5 billion. And these ones target specific sectors. $25 to $100 million. They target specific sectors, and they deal with the middle level companies. Then you also have, and I've given an example for each case. For the mega funds, that's why you'll find the big private equity firms, global large private equity firms, including BlackRock, the Blackstone, and KKR. Then you have the growth equity. You know, they target small firms, build and buy. You build small companies that are coming up, growth stage, then you buy it. You buy it. You'll find private equity firms that specifically deal with that. And then you have sector specific. So they go with for the middle market, and they look specifically for distressed firms like NBK, National Bank, before it was taken over by KCB. That is a perfect example of a distressed firm. Of course, you know there are several in this country. In the sugar belt, they are financially distressed sugar millers. And of course, our own airline carrier, KQ. The financial institutions, private equity with the financial institutions, these ones invest across all sectors. Across all sectors. Goldman Sachs. Good example. The IFC, which I'm talking about, is a financial institution. But not the bottom line. They are putting money where they know the value of the firm will go up, and then they will get some returns. They will realize some returns out of this. Let's see the Kenyan scenario. You know, we have seen an increase in private equity firms seeking to invest in Kenya. An increase. And they are targeting several sectors, not just one, including fast-moving consumer products. And when you look at the entire Africa scenario, you'll find that most of the private equity is either going to Nigeria or Kenya or to Zimbabwe. And Zimbabwe, the amount of money involved in the private equity in Zimbabwe is too much because they are acquiring the mining. You inject capital, leverage buyout to acquire a mining company. It is not small money. So last year, 2023, because 2024 is not yet over, so we don't have statistics for the entire 2024. So we base our analysis on last year. Most of the private equity deals in the whole of Africa were concentrated in East Africa, as you can see. Still, last year, we saw a private equity deal of 23.6 million by B Commodities. This is a company from Sri Lanka. It injected private equity into, some of you come from those sides of, is it Kericho County or Bomet, where you are at Finlay? So the Scottish multinational, James Finlay, is no longer existing in Kenya. Those from those sides. You know, Finlay, James Finlay has invested a lot in the tea plantations, let me call it the tea industry, in those sides. So they sold 85% of the shareholding to this Sri Lanka company, and 15% went to the Kipsigis Highlands multipurpose. Still last year, we observed private equity injection of that 6 billion by IFC into Safaricom Ethiopia. Remember, in the beginning I said that the leverage buyout can be equity or can be a combination of both. Of both. So in the case of Safaricom, you have an injection of private equity of 22 billion and 14 billion as debt. Remember the pie theory in the capital structure topic, that a firm can only finance its operations either equity or debt, but the percentage shareholding differs. There are companies that will finance more with leverage, and that's what we call debt. So what happens here with IFC? It hopes that it will get a good return from Safaricom Ethiopia from the equity. Normally, of course, you know, if you are an equity holder, you are the equity holder, this company makes a net profit of, say, 100 billion in Ethiopia. So Safaricom will be entitled to the fraction that, IFC will be entitled to the fraction they invested in Safaricom Ethiopia. The debt component is just like the preference stock. It comes with a fixed interest rate. Fixed interest rate. So in 2022, here in Kenya, we saw the Moroccan furniture retailer, the Kitea Group and Pan-African Private Equity Firm, acquire almost 56% of the furniture price. You walk around in town, you see the furniture price. Furniture price. Initially, it was 100% owned by the founders. But then they needed the capital to expand. Capital to expand, that equity. So they got it from this Moroccan group. 2018, you know Sokoni, Retail Kenya. Sokoni, it is owned by Adenia Partners. The Adenia Partner is a private equity firm. It is calling itself partner because, like we said, in the structure of the private equity firm, there is a general partner and the limited partner. That's why it's calling itself the Adenia Partner. And therefore, they acquired majority stake in Tumaini Supermarket. You used to see Tumaini. You don't see it anymore. You don't see it anymore. Because this Sokoni, after acquiring, injecting capital, it is a leverage buyout. So Tumaini, how much money are you worth now? 10 billion. Here it is. And therefore, Adenia becomes the owner. In Kenya, they trade by the name Sokoni. You normally see it, Sokoni Retail. They took over that. And 1 year later, they acquired Quickmart. by injecting private equity. They injected private equity into Quickmart. That was 2019. You know, the founder of Quickmart, John Kinothia, relinquished control. What does that tell you? It tells you that the amount of capital they injected in Quickmart is higher than what the founder, John Kinothia, had put. So the minute the shareholding goes up from the one who has injected the private equity, then you lose control, which means you can't even appoint a manager, which means the company now is run by Adenia or the Sokoni Retail Kenya.